By the way, the other thing is when we do these webinars, whether it's the free ones remaining or when we start charging, remember, we're trying to get an idea of what you as a student want to go over. But if you go in there and take the exam and you fail using other courses, as I mentioned so many times, right, you may not pass because they are not using the AICPA blueprints. If I tell you they use the AICPA blueprints in determining what subjects they're going to actually test, and they actually go right to the blueprints. They don't say, well, let's read the blueprint. Maybe we'll do this based on, no, they're definitely going to take that subject that's in the blueprints and ask those tasks under those subjects. And that's what we're covering. So listen to us. Hey, you're welcome to buy the books. Better than any other books I've seen on the market. So anyway, but I'm biased, right? I'm prejudiced, biased, whatever you want to call it. So anyway, enough of me, all right? And one other thing, Carrie called this a mini CRAM. Let me just clarify here. We do have a CRAM course you can buy on video. That is completely different from this. What we're trying to do is, we're trying to take a few subjects and go more into depth on them in a couple of hours than the CRAM course, where you don't spend an hour or 2 hours on a specific subject. But the CRAM is a good wrap up, another product that's available to you. So anyway, without further ado, I want to introduce Ron Primoroso. Ron is always my partner in crime on these webinars, all right? Excellent teacher. A lot of you know him because he keeps in actually correspondence with you once you get in touch with him. So Ron, take over and good luck, Ron. I know you can do it.
Thank you very much, Phil, for the usual great introduction. And so today I'm going to cover, let me just share my screen. Let's see here. Okay, so as Phil said, hold on.
There we go, Ron.
I'm skipping around here. Here we go. There we go. So as Phil said, we have a lot of experience working with candidates, Phil a lot more than me. And one of the topics I feel I hear a lot about from candidates that they want more explanation of, they want to go through it, they want to understand it, is on variance analysis, okay, standard costs. Now, why, Phil? Okay, first of all, it's a blueprint item, right? And we have it right there at the top of your screen. Okay, the blueprint that the ICPA has issued, and by the way, this is content section 5, right, of BEC, okay, is determine the appropriate variance analysis method to measure the key drivers by analyzing business scenarios. So Phil, why is standard cost so important to know and understand? Well, it could be a series of multiple choice questions, Phil, right, on the exam. It could be a simulation question, okay, where they give you a bunch of information on standard costs and ask you to calculate variances. Or remember now, Phil, this is BEC, right? And there are written communication questions, right, on BEC. And they could paint for you a scenario, Phil, on standard costs and ask you a series of questions, or for you to write a memo, right, to the CEO or the CFO, right, addressing the concepts behind standard costs, okay? So please, for you candidates that are studying for BEC, and by the way, I had a lot of people I work with YAEGER candidates recently taking BEC. Some told me they couldn't believe how many questions they got on variance analysis, okay, Phil? Others told me they didn't get any questions, right, on standard costs. So like Phil said, you never know what's going to be on the exam, okay? You never know which of the blueprint items are going to be emphasized, right, Phil? There's like 4,000 questions in a pool for each part of the exam. And we don't know, frankly, how many are multiple choice out of those 4,000 and how many are simulations, okay? So, but your goal as a candidate always, and that's where we believe YAEGER is special, is to study the blueprints and make sure you know the blueprint items as well as possible before you go into the exam. Acknowledge your weaknesses, right? And strengthen those weaknesses so, God forbid you get one of those questions or simulations that you're in a good position to answer. those concepts, okay? All right, so let's go through standard costs, okay? And in our book, I'm on page 5B-27 for those of you that are YAEGER candidates and have our books available. That's what I have up on the screen. So basically a standard cost is some type of a predetermined cost per unit of output under circumstances. You can imagine most sophisticated manufacturing companies develop standard costs, okay, for the products that they manufacture, okay, broken down into materials, labor costs, right, and overhead costs. And by the way, those concepts should be very familiar to you because you need to know them for job costing, for process costing, right? All of the different costing concepts, which I'm not going to cover today, quite frankly, but you know, they're very important overall concepts. So managers base standard costs. Why do managers establish standard costs? Well, they want to identify abnormalities, okay? Positive, right, cost changes and negative cost changes. And why is it important to identify both, Phil? Well, if they're negative, you want to take steps to eliminate them, right, in the future. If they're positive cost changes, you want to understand why you had a positive cost variance and try to do your best to maintain that in the future, okay? And by the way, I'm doing, Phil, there, a BEC question there for written communication, right? A good answer to a question if you're given that on the BEC part of the exams. Standard costs are preferred over actual costs because managers don't need to delay the costing of a product, right, until the books are closed, right? If you close different production cycles or production units during the period, you use standard costs, close the books, right? Do your costing, book your entries, and then at the end of the month when the accounting people close the books, you can reconcile the actual cost to the standard costs. All right, so variance analysis simply describes the difference between the actual and expected or standard results, okay? And like I just said, variances help managers prioritize their attention on poorly performing areas, right? Negative variances from standard costs or areas that fail to achieve targeted levels. This is called management by exception. Don't forget that term, okay? Management obviously focuses on things that are problematic, okay? Variance analysis starts with the master budget. I'm not covering master budgets today. We have a section in our materials on master budgets, but that's where variance analysis starts, right? A master budget budgets the material, labor, and overhead costs for a production cycle, okay, during a period of time. It's created at the beginning of the period, and it's a snapshot of what management plans to have in the future for standard costs and sales. Then using the master budget, we now move into the variances, okay? Direct material variances, direct labor variances, and variable overhead variances. For each of the items, you can relate price and efficiency in terms of the number of units. When the actual quantity or the actual price is different than the standard quantity or the standard price, that means you must have or you will have a favorable or unfavorable variance. Favorable variances exist when, of course, operating income, right, which is revenue minus costs, increase compared to budget. Namely, when actual revenues are more or costs are less than anticipated. And of course, unfavorable variances occur when operating income is lower, right, compared to the budget, all right? All right, so let's dig into more details specifically on standard costs. And most standard cost analysis and budgets start with the direct materials, okay? So for direct materials, we have two potential variances. One is called the price variance, okay? And as intuition may tell you, the price variance should be or is the difference between the actual price you pay for something and the standard that you set when you set your standard for direct materials for something, okay? So if you're buying yarn, for example, right, you may have a standard price per yard, right, of yarn, and you may when the purchasing department makes the purchases, right, there will be an actual price. And if that differs from the standard price, right, you will have what's called a purchasing price variance, okay? So be careful here with the terminology, Phil, right? It could be price, direct materials price variance. A lot of times it's called the purchasing price variance, right? Is the difference between the actual and the standard input price, okay?
Ron,
Now,
where do they come up with this standard cost? Is it like a target? Where do they come up with it? And does it change at times?
it changes all the time. So it, you know, Phil, depending on what the commodity is, right? Depending on what the material is, the first thing that management does is look back at the history, okay? What has been the historical price we've been paying for these particular materials, okay? Then they look forward and say, well, you know, this product is linked, for example, to oil, right? So today, Phil, right, if something was linked to the price of oil, you could probably anticipate that you're going to lower your standards, right, in the future because the price of oil has dropped by what, almost 50%, right, in the last 6 months. So definitely, Phil, you reset your standards all the time. Now, are they perfect, Phil? Of course not, right? There are things that are going to happen because you're budgeting a year ahead, right? Your standard for the materials, and the price of oil could go up, price of oil could go down in the next year. But that will be part of your analysis, Phil, right?
Thank you.
Once you get your standard versus your actual price in the future. So we have a hint here in the box, and this is very important, Phil. For direct materials, most of the times that variance should be recognized at the time of the purchase, not at the time that the materials are used or pulled out of the warehouse to put in production, okay? That variance should be recognized right at that point in time in the interest of A, conservatism, and B, Phil, who really is responsible mainly for the purchase price variance on materials? What department, Phil, inside of the company?
Well, what department? I would say
Yeah.
where they store the materials, that type of thing. What's that? Is that what you're talking about?
Well, more the purchasing department, right? They're the ones
Right,
that
I'm
buy
sorry,
it, right?
right.
Yeah, I mean, the usage later, right, will be accountable to the warehouse or to the production people. We're coming to that next. But generally speaking, for materials, the purchase price variance is generally the sole responsibility of the purchasing department. And by the way, you're going to see a multiple choice question coming up, which will ask you that, okay? And again, Phil, that could be part of a BEC communication question, okay? Where they're asking you, who should we investigate or who should we be asking about purchase price variances within the organization? Which department or which function? And generally, Phil, it's the purchasing department, okay? All right, so this equation can also be adopted, Phil, to determine the selling price variance by substituting the actual quantity purchased with the actual quantity sold. So Phil, let's go to a question which you can read to our group here, illustrating this calculation. And I'm going to scroll to that right now. It's question 85 in your books, okay? You can see I use the search function. And there it is, question 80. I'm so proud of myself, Phil. I finally learned how to use our search function. And here's the question here to read to them, Phil.
To meet its monthly budgeted production goals, Acme Manufacturing planned a need for 10,000 widgets at a price of $20 per widget. Acme's actual units were 11,200 at a price of $18.50 per widget. What amount should be reflected as Acme's selling price variance?
Okay, so all of you on the call, right? You should have a piece of paper out right now, right? And take into consideration the facts in this question, right? That Phil just read to you. And tell us or calculate for us what is the selling price variance here. I'll give you a second to do that. And you can put your answers in the chat box if you wish.
So far, there are no answers, Ron.
No answers.
Yeah. All right, we have a person who came up with the answer C as in Charles.
C as in Charles. Okay. Anybody else?
We have another person, C as in Charles.
Good. Well, anybody else?
Yeah, third one, C.
Yes.
See?
Yep.
See?
So, yeah, so how would we calculate it, candidates? Well, first of all, the sentence which says Acme planned the need for 10,000 widgets at a price of $20, that's nice information, but that means what? The standard price, right, is $20 per widget, correct? All right. Now, the actual units sold were 11,200. So wouldn't we take 11,200 units, right, times the $20 standard price, right, which is what our budget told us we would sell it at, right, minus $18.50, right, which is the actual price. So 11,200 units, right, times $1.50 is 16,800, okay? And is it favorable or unfavorable?
Well, since there's only one answer with that, Ron, I would say it's unfavorable. But I'm looking at this now.
Yep.
The price, the actual price is $20, right?
That's the budgeted price.
I'm sorry, the standard. The standard
The
is 20.
standard price is
But
20.
we only spent $18.50, right?
We only sold it for $18.50.
Oh, we only sold it for $18.50.
So we sold it for less, right, than the
Okay.
budget, right? So that's $1.50 less, right, times 11,200 units. So the answer here would be C, like everyone has said, Phil, 16,800 unfavorable. And actually, Phil, I'm going to recommend we change this one to put a favorable and unfavorable in there, right, just to cover the mistake, okay, that someone could make on a question like this, okay?
Okay.
Great. All right, let's go back to the lecture. So that's a question covering sort of the direct materials purchase price variance, but also the application of it to the sales variance, okay, sales price variance. So let me go back to 5B-28. There we go. All right. So next, not only do you have a direct materials price variance, you also have, as you can see on the top of the page here, a direct material fill efficiency variance, okay? So first you isolate the price variance, right? How much you bought it for and how much the standard different from actual. Then you move on to, right, it's gone into the warehouse at this point, Phil, right? The materials. It now gets issued to production. And of course, there is a standard for how much materials should be used, right, in producing a unit. And the efficiency variance is also called the usage or volume or quantity variance, okay? So be careful, candidates, okay, on the exam, because they can term the efficiency variance any one of these terms, okay, is the difference between the actual input quantity and the standard quantity allowed based on the units produced during the period, okay? So we have our formula there. The efficiency variance for materials is the actual quantity of materials used minus the standard quantity allowed based on the number of units produced times the standard price, okay? All right, so let's illustrate that one too, Phil, with a question. Let me move to that. And that will be BC 5-86, which Phil will read to us now. Whoops. BC5. Huh. So I'll scroll to it, Phil.
Okay.
I guess the search function doesn't like me.
It's technology, Ron. I think you're in the answers.
Yeah, I don't want to be in the answers. There we go. BC.
Now, the one area I disliked most besides auditing was cost accounting.
Yes. And that's because most people, Phil, only have one cost accounting course, right? They may take a second in their master's program, but a lot of people do not, right? So
Well, I had two of them in undergraduate, and they were still as boring the second time as, no, you know what? Unless you work in this field of manufacturing, it's hard to see it, especially with the overhead variances. This thing, you can come up with a formula. Actual times actual, standard actuals times standard, standard times standard.
Yep, exactly.
Right.
Yep.
By the way,
And
all
you
right,
can, and you
86.
can kind of logic your way through these, okay, Phil?
All right,
So
here we go.
let's see if the candidates can do it here with
For the
number
current period
86.
production levels, XL Molding Company budgeted 8,500 board feet of production and used 9,000 board feet for actual production. Material costs were budgeted at $2 per foot. The actual cost of the period was $3 per foot. What is XL's material efficiency variance for the period?
So candidates, will give you a second to figure that one out. What's the formula for material efficiency variance?
Well, you're
Standard
comparing
costs,
actual
right?
to the standard, right?
Standard cost times budgeted
I'm
minus
seeing a lot of people enter B as an answer.
B as an answer, 1,000 unfavorable. Great. So what would be the calculation? The standard cost per unit, right? For the material cost is budgeted at $2 per foot, right? And we would subtract, right? 9,000 board feet was the actual, 8,500 board feet was the budget, right? So that was the standard allowed for production. So we had $500 more board feet, right? Used for the production than budgeted times the $2 budget. And the answer, of course, is B, 1,000 unfavorable, okay? So you notice the actual cost in there, Phil, is a smokescreen, right? That is not something you needed in that question to answer that question. You would have needed actual cost for what, Phil? The price variance, right? The material price variance. But that's not what this question is asking you, okay? It's asking you the efficiency variance, okay? Well done, candidates. All right, Phil, let's go to the next question, which is, I think 87 is a very similar question. Here we go.
It says relevant information for material A follows. The actual quantity used was 6,500 pounds. The standard quantity allowed is 6,000 pounds. The actual price is $3.80. All right. And the standard price is $4 per pound. What is the direct material quantity variance for material A?
Candidates, give you a minute there.
Seeing a lot of answer D.
Answer D, 2,000 unfavorable. Again, the formula is what, candidates? Standard price, right? Times actual quantity minus standard quantity, right? The actual price there is meaningless for us, right? We only need that for the price variance. So standard price of $4, right, candidate? Times 6,500 minus 6,000 pounds. So we've used 500 more pounds, right, Phil? Than was dictated by the standard. 500 pounds times $4 equals 2,000. Answer D, unfavorable. And by the way, Phil, this is a very good AICPA question because you can see the favorable and unfavorables are there, right, Phil? In case the candidate makes a mistake in their calculation, that's more of an AICPA question, I would say, than the other one, okay? All right, let's go back to the lecture. So we've covered the material variances, right? Purchase price, and also, so I'm going back to 5B, I hope, dash 28, where I will cover direct labor variance. Oh, voila. Okay, direct labor variances. So, just like materials, right, where we had a price variance and efficiency variance, the good news is we also have a price and efficiency variance for direct labor. Okay, so the price variance is also called, and I warn you again, make sure you're conversant, right, with these different terms, rate variance, direct labor rate variance, okay, is the same thing or it means the same thing as the direct labor price variance, okay? And what the rate variance is for direct labor is the difference between the actual labor rate, okay, the hourly pay rate for people on the production floor, and the standard direct labor pay rate, okay? So, and by the way, candidates, can I ask you a question here? Who within the organization might be primarily responsible for variances between the standard direct labor rate and the actual direct labor rate? Who might be operationally responsible? Can I see some thoughts from the candidates?
Operational managers, Ron?
Could be. Who else? More specific?
Human record, says human resource, that's
Yep.
correct.
Human resources. Yep.
How about the
Exactly.
payroll department? How about the payroll department?
Could be if they're linked together with, that's more of an accounting function, right, Phil?
Okay, so HR probably is the best answer.
Best answer there definitely is HR, okay? Or the supervisors or managers, right, running the production floor, right? Not managing the direct labor personnel the way they should be, okay? But more, the hourly rate, Phil, will be set by human resources, is my experience, okay? So again, that's a good thing to remember, candidates, for the future. All right, so that's the price variance, Phil, for direct labor. Very, very similar, right, to what we had on materials. And efficiency, right, is also called the usage variance, right, for direct labor, is the difference between the actual input quantity and the standard quantity allowed based on the units produced. And that should sound very familiar to what we did on direct materials, okay? So we have two nice hints in here. The calculation for price and efficiency variance is the same for direct materials and direct labor, although the names may vary slightly, so don't be fooled, okay? And both the price variance and the efficiency variances are controllable, right? Right, Phil? We said direct material price variance is controllable by purchasing. The direct labor variance is controllable by human resources, right? Or the managers on the production floor. Please remember that, right? For your operational type multiple choice questions you could get on B, C, okay? All right, Phil, so let's do some practice questions here. And let's see if I get lucky this time. BC 5 question 88. Oh, voila, it worked that time.
And here we go. All right, management has reviewed the standard cost variance analysis and is trying to explain an unfavorable labor efficiency variance of $8,000. Which of the following is the most likely cause of the variance? First one says, is the new labor contract has increased wages. The maintenance of machinery has been inadequate for the last few months. C says, the department manager has chosen to use highly skilled workers. And D, the quality of raw materials has improved.
Candidates, which is the best
I think we can knock
answer?
out D, can't we? Because it mentions raw materials.
Yeah, exactly. Yep. So we're down to 3, okay? Candidates, which one?
We get some answer A's here.
Well, let's talk about answer A. The new labor contract increased wages. Isn't that for the price variance, right? Not the efficiency variance. So it can't be answer A, right? Be careful. What about C? The department manager has chosen to use highly skilled workers. If that was true, that would result in a favorable labor efficiency variance, not an unfavorable efficiency variance. So answer C is out, okay? Leaves us with answer B, right? The maintenance of machinery has been inadequate, right? If machinery is not being used, right, or being maintained adequately, wouldn't that affect the efficiency of the labor being applied to produce units, okay? So definitely, Phil, the answer is B. This is a good one, okay? Because it tests your knowledge of materials, labor, right? And also price and efficiency variances, okay? Anybody get B, Phil? I'm just curious.
Yeah, the first person, I think, said C. There were 2 B's and then a C and then a B.
So make sure you understand the wrong answers there, okay? All right, Phil, let's do 89 there because that's direct
Okay,
labor too.
89 says, Ron, we have a company who produces widgets with budgeted standard direct materials of £2 per widget at $5 per pound. Standard direct labor was budgeted at 0.5 hour, half an hour per widget at $15 per hour. The actual usage in the current year was 25,000 pounds and 3,000 hours to produce 10,000 widgets. What is the direct labor usage variance?
And Phil, I would say this is a more typical CPA exam question, okay? Lots of information, lots of numbers, and lots of stuff in there that you don't need either, okay? Just to give them some hints. So candidates, take a shot at this one. Any answers, Phil?
I have no answers yet.
That's a tough one, very tough. What's the formula, candidates? Right? Standard hours allowed, right, for the production made during the period, minus the actual hours, right, used during the period, times the standard rate per hour. Almost half of the information in that question, Phil, was useless. What are the candidates, what are the standard hours allowed for the widgets that were produced during the period? How many widgets were produced during the period, Phil? 10,000, right?
Right.
What is the standard number, right, of hours per widget? 0.5, right?
Well, 0.5. That's
By per widget, right?
0.05.
0.5, right? Half an hour per widget. So 10,000 times 0.5 is what, candidates? 5,000 hours, right? Is the standard hours allowed? How many hours were actually needed to produce the 10,000 widgets? 3,000, right? So 2,000, right, was a favorable amount of direct labor hours, right, in producing these widgets during the period. And what is the standard fill direct labor rate per hour?
It is
15.
Ron.
15.
Right.
So 2,000 hours, right, favorable, times $15 per hour, the standard direct labor rate. And the answer is C, right? 30,000 favorable. Okay. So candidates, this is a typical, I would say, Phil, CPA exam question, right? Almost half of the information in there, right, had no use. Okay. The 2 pounds per widget at $5 per pound, Phil, that would have been for a materials question, right? Not for a labor question. The 0.5 hours per widget standard and the $15 per hour standard, that's an important part of answering this question. The usage was 25,000 pounds, again, irrelevant to this question. 3,000 hours to produce the 10,000 widgets. So you had to calculate here the standard hours allowed, right, for the production made during the period, which is 10,000 times 0.5. Any questions there, candidates?
Well, if you look at this, I think this would make for one type of simulation is a document simulation,
Yeah.
right?
Yeah.
Which means they give you some documents to
Yeah.
get this information.
Yes.
Okay.
Yeah. Materials documents and labor documents. Yeah, you're right.
Right.
You're right. Exactly right. Okay. So we've covered direct labor. Let's move back now to variable manufacturing costs, and that's on 5B-28. Any other questions, Phil, while I'm finding the page?
No questions.
Okay, 5B-28. There we go. All right, so we've done direct materials, direct labor. Next, variable manufacturing overhead, okay? So we can also have spending and efficiency variances, right, related to variable manufacturing overhead. So the variable manufacturing overhead spending variance is the difference between actual variable overhead costs per unit of the allocation base, right? So for example, you might be allocating variable manufacturing overhead costs based on machine hours, direct labor hours, direct labor dollars. You know, could be all kinds of different factors there, but we put in there an example of machine hours as a basis for allocating variable manufacturing overhead costs. And by the way, you generally try to allocate variable manufacturing overhead costs based on some type of direct functional relationship between variable costs and something happening on the manufacturing floor, okay? So the variable overhead spending variance is the difference between the actual variable overhead costs and the standard cost per unit for the allocation base, okay? So the spending variance for variable overhead costs is the difference between actual and standard times the actual quantity used during the period, okay? So let's look at an example of that one, Phil, on BC 590.
You want to try next? Did you go? Okay, 90. Oh, reading
Yep.
90.
Yep.
Here we go. A company has gathered the following information from a recent production run. The standard variable overhead rate is $10. The actual variable overhead rate is $8. The standard process hours are 20, and the actual process hours are 25. What is the company's variable overhead spending variance? And notice here, they have 2 answers for each one. If you like 50, they have unfavorable, favorable.
Yep.
40, unfavorable, favorable.
Yep. So they try to catch every computational mistake, right, Phil?
Mm-hmm.
And if you don't understand, right, how to calculate the variance, the answer is there, of course, okay? Any answers?
Yes. Coming in. Wire, here we go. It's a photo finish. It's letter B. Do we hear letter B from anybody else? We still have people. All right. No, it's not letter D. Check that. All right, someone got letter D.
Yeah, I'm seeing a lot of, I'm basically seeing responses for all 4 answers. So maybe this would be a good place to really break down
Yeah, so, okay, so what's
what people are thinking.
Yeah, so, yeah. Let's see why you're calculating some of the answers there, candidates. What is the formula here, candidates?
It's actual hours.
Yep, times.
Actual hour. Actual, all right. So the actual hours, 25 times $8. See, I do it a little different way. All right. All right. Because I use that formula. Actual, I don't want to, should I throw it in and tell them what I use?
Well, after I describe the easier way, okay? Your way is correct, of course, but it's 25, right? The actual hours times the difference between the standard and the actual rate, okay? So $25, 25 hours times the difference between the $10 standard rate and the $8 actual variable rate, right? So we know the actual variable rate, Phil, is less than the standard rate, so it's going to be what? Favorable, right? And if we take the 25 actual process hours times $2, we get answer B, which is $50 favorable. You can go through your method, Phil, too, because that is taught.
Well, this is a method I learned in school, okay? All right. You put up the formula. A, that's the first layer.
Yep.
All right. A, S.
Yep.
And then SS.
Yep.
All right. Now, because this is an efficiency spending variance,
yep.
All right, we're basically going to do this. We determine the A times the A is the actual hours, right? Are we dealing with hours here? All right.
20,
so A would be actual hours, correct?
Correct. Yep.
Right. And the actual hours are 25. So
Right.
I put 25 minus, all right, the actual price, right, which is $8.
Yep.
All right. So that gives me, I think I'm confused the people because they can't see this on a board. All right. But I learned, did anybody else, I'm just curious, did anybody else, I see some formulas on here, all right?
Yeah, but you're right,
Actual
Phil,
times actual.
on the left, you would have A times A, which is 25 times 8, right?
Right.
Which is 200. And in the middle, you would have A times standard,
So
okay?
you have 25
25 times 8,
times
right?
the
Which is
standard
200.
hours are,
Yeah,
it's,
which
I'm
is
sorry,
10.
standard rate is 10.
Yeah, so you'd have 200 on the left, 250 in the middle, right?
Yeah.
And there's your 50.
And it's standard times standard. So it's standard hours of
Yes,
20 hours
yeah, all the way on the
times the
right.
standard rate
It's
is 10.
200,
And
200.
that would be what, 200?
Yes, yep.
So are the three amounts, actual times actual comes out to what? 25 times 8 is what?
200.
200? All right. So what we have here is, if you look at our, compare the first to the second, we're comparing the actual dollars to the standard dollars.
Yep.
The actual is 8. The standard is what?
10.
10. I'm trying to
250.
teach at the same time. All right. I don't want to confuse the issue with these
It's
people.
250, but yeah, you get the same answer, which is good,
Yeah.
Phil. Actually, that's the way I learned it in school, similarly, Phil.
I am just
Okay?
curious. I'm asking the panelists, not
Yep.
the panelists. We're the panelists. I'm asking the students. How did you learn? Did you learn by the formula actual times actual, actual times standard, standard times standard? Yes or no? Did you learn it that way? Please answer. Yes. I have one person say yes.
Yep,
I have another person, no, no. All right.
yep.
I've been out of school so long, I can't remember.
That's
All
normal.
right. Is a person yes? Well, I guess it's sort of up too long ago.
Yeah.
You know something? All right. I'm just curious. The person who wrote too long ago, how long have you been out of school? All right. The one who wrote too long ago. 12 years.
Yeah.
All right. Well,
Unless you use this, Phil, you'll never remember, to be honest. You know, and you.
I have to say, Ron, I have taken that actual standard. I will take that to the grave. No, actually, it just sort of, you say that.
Yeah.
All right. All right. But anyway, all right. Go ahead, Ron. I didn't mean to keep you.
Yeah, no problem. By the way, candidates, taking what Phil just did there for you, we did the spending variance, right? Which is the left side of what Phil just did. What would be the efficiency variance in this situation, Phil? Well, the middle's 250,
5
Phil,
hours
right?
times 10.
The middle is 250, the right side is 200, right? So there'll be a $50 efficiency variance, right? Unfavorable,
Right.
right? Because it took 5 more hours, right?
Right.
25 minus 5 took 5 more hours to produce the goods, right? At the $10 standard, okay? So it would be $50 unfavorable, okay? If this question was the efficiency variance, all right? All right, let's go back to the lecture because I'm running out of time here. All right. So let's finish the variable efficiency variance, right? And I actually just did that last question for you with Phil doing the efficiency variance. And there, the efficiency variance is difference between the actual quantity of the allocation base and the standard quantity. Or as Phil had in his mosaic there, right? Actual times standard compared to standard times standard, okay? For those of you that learned it that way, okay? And that would be how you would calculate the efficiency variance, okay? So let's move on now to the fixed manufacturing overhead variance.
Can you go back to the middle thing there? Are they using that formula AA? Is that what they're doing?
Not similar to
exactly.
what you said.
Okay.
No, similar, but no.
Okay.
And,
All
you know,
right.
and that might be something good for us to put in the book, to be
Yeah, I
honest.
think so.
Phil. Yeah,
Yeah.
I think we should. Yeah. Okay. Fixed manufacturing variance. Okay. Now let's be careful here. Okay. Because this is a little bit different than the variances for materials, labor, and variable overhead. The spending variance is actually very simple. Okay. It is the difference between the actual fixed overhead, spent during the period and the budgeted fixed overhead for that same period, okay? It's also called the flexible budget variance, okay? So if you get a question like this on the exam, you should thank the examiners, okay? Because all it is, the budget variance, the flexible budget variance is simply the difference between the actual fixed overhead. And by the way, candidates, what would be examples of actual fixed overhead during the period in a manufacturing operation? Phil, let's see what they say. Fixed manufacturing overhead. What would be an example, candidates?
That's correct. The best answer is rent.
Rent, yep. Office factory rent, what else?
The foreman's salary, does that count?
Yep, foreman's salary is a fixed salary, good. What else?
Property taxes,
Yep, what else?
production machinery. Well,
Production machinery depreciation, right?
depreciation.
Yeah,
but
not the
production
machinery.
itself.
Not the machinery itself, right? Those are examples of fixed
And
manufacturing.
administrative expenses, correct. That would be, you know, the office workers' salaries, that type of thing.
But only
It's not
related
based on
to,
producing.
yeah, but only related to production, Phil, right?
Right.
Not the finance and accounting people, right? Those are period costs, right?
Right.
Not manufacturing costs. Okay. All right. So it's important, candidates, to remember for fixed overhead, there's no efficiency variance. Okay. As long as the plant is manufacturing and producing products within what's called the relevant range, right? At its maximum production capacity, you never have an efficiency variance, okay? Now, the second fixed manufacturing overhead variance is called the production volume variance, okay? That's the difference between the budgeted fixed costs and the fixed overhead, which is allocated based on the number of units produced during the period, okay? A favorable variance indicates that the overhead was over allocated, okay, in the production volume variance. An unfavorable variance means that the actual fixed overhead expenses were greater than what was anticipated, and therefore it's under allocated to the production, okay? It is important to understand that the production volume variance is not controllable, okay? It is an indication of how much of the company's capacity is being used. It is only applicable to fixed overhead, okay? All right, so for fixed manufacturing overhead, we have two variances. One is a pure spending and budget variance, and the other one is, right, fixed manufacturing overhead is allocated to production based on the level of production, right? And if you underproduce the number of units that you budgeted to produce during the period, right, manufacturing overhead would be underallocated. And if you produce more units during the period that you budgeted, right, then it would be a favorable situation in that you would be applying fixed overhead costs to more units than you were anticipated during the period, okay? All right, and really that's what you should know for fixed manufacturing overhead expenses, okay? All right, Phil, so let me turn to a few more questions.
What I've heard from students is it's the overhead variances that give them more trouble than anything else.
Absolutely, and I think the fixed especially, okay? And for the variable, right, making sure that you're doing the allocation based on the information that you're given in the question is important, Phil.
All right, let's go to 91. And 91, okay, here we go. Can you bring, all right. Which of the following types of variances would a purchasing manager most likely influence? Direct material price, direct material quantity, direct labor rate, or direct labor efficiency? Well, purchasing has to do with purchase of materials, correct, Ron?
Absolutely.
So it has nothing to do with the labor rates,
No.
right? The Human Resource Department determines that.
Yep.
So, all right.
Candidates?
We're seeing a lot of A's and B's, so that's good that they have not fallen trap to the C or D.
Yeah, there's only one answer, ladies and gentlemen, one answer.
Right, but
Yeah.
yeah, we're seeing it's sort of a split.
Yeah, so really the answer is A, candidates. Why? Because we said earlier, right? The direct materials price variance, most of the times in most organizations, materials are purchased by the purchasing department, right? Using a purchase order, using a purchase requisition, right? Some of those documents you should be familiar with for studying from the exam, right? For FAR or auditing. So purchasing manager has nothing to do with the quantity, right? Because that's when it's been issued to production, and that's under the control of the production manager or the production supervisor or the production foreman.
Ron, could you also say direct material price? That's determined at the time the goods are purchased, right?
Yes. Yep.
Direct material quantity is determined when the goods go into production.
Yeah, I mean, the goods have already been purchased, Phil, received, put in the warehouse, and issued to production, right? So that's way past any of the responsibilities of the purchasing manager, okay? All right, next question, Phil, 92.
SMART uses a static budget, all right, when actual sales are less than budget, all right? SMART would report favorable variances on which of the following expense categories, all right? Now, we have sales commissions
Yep.
and building rent. And you see the responses here, yes, 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 no, no, yes, no, no, okay?
Any
Well,
answers?
I would think if sales are less than budget, all right? That's gonna affect your sales commissions, right?
Yep, and would it be favorable?
It would be unfavorable, right?
If actual sales are less than budget. Your commissions, right, which are variable
Oh, our
expense.
commissions would be unfavorable, right?
But if actual sales are less than budget, would you pay more commissions than budget or less
Pay
commissions?
less commissions.
All right, so that would be B, right? B
Right.
or A or B, right? Building rent candidates is what kind of expense we said?
That's fixed, Ron, isn't it?
Fixed, yep. So if the actual sales are less than budget, would building rent be affected?
No.
No effect, right? So it would not be, right? So the answer would be no, right, for B. So the answer is B, right? Sales commissions would be favorable, right? The variance, and for building rent, it would not be favorable, right? There would be no
You did
variance.
say, Ron, the fixed overheads are generally not, there should be no variance, right?
No variance,
Right?
that's
And
right,
that's because you have that cost no matter how many goods you produce.
correct. Yep. You've signed an agreement for the rent, you're depreciating the equipment in accordance with generally accepted accounting principles, right? It's not gonna vary. It's gonna be the same regardless, okay? So,
Okay.
yep. Okay, Carrie, so I've covered, the four main concepts, okay? And in our book, right, there's a bunch of additional tables which go through standard costs. And we really hope that this session has helped you, feel better, feel more confident on the operational side, but also the calculations that are required for standard costs. And I turn it over now to Carrie.
Great. So Ron, I know you're planning to move next to the auditing section of the exam.
Yep.
So if you want to take a second and start pulling up the materials that you want to share there.
Yes.
I am going to, again, put in our chat box the link to the poll that we have for the webinars for the next 2 weeks. I did take a look while Ron was talking, and we did get a couple of answers. We really appreciate that. This will help us to get a little bit more focus on what will be the most valuable for all of the candidates for the regulation and auditing sections of the exam, which we plan to do for the remainder of June. In addition, I'll go ahead and put the link in a moment to the AICPA website page that talks about the switch to the continuous testing model that I discussed at the very beginning of the webinar. This is something that they are going to be implementing as of July 1st. I keep saying June. And it's going to be kind of an interesting period for the next several weeks, since normally in the previous model of testing, the testing for Q2 would have ended on June 10th. Obviously, with the COVID-19 pandemic, they have had to go into emergency testing, and so therefore are extending through the remainder of the month. The information on when those score releases for any remaining scores from tests taken in Q2 are also available on that webpage, and then it does break out the score release schedule for when we switch over into continuous testing. So in just a moment, I will put that link in. Again, if you guys have a quick second and can click the Google form that I had included in the chat box and let us know the topics you'd like us to cover, we'd really appreciate it. And other than that, Ron, if you're ready, you can go ahead and switch over to the simulations from the AICPA practice exam.
Okay, welcome to those of you here for the auditing for the practice sims. And can they see my screen? I think so, right?
Yes.
Great.
Yep.
So just to emphasize, right, on the auditing exam, right, 72 multiple choice questions, 8 task-based simulations. Your final grade on auditing is allocated 50% to the multiple choice questions, 50% to the task-based simulations. And on auditing, right, there are 8 task-based simulations. And if you do simple math there, right, you're allowed about 15 minutes per simulation question, okay? So that's very important to keep in mind as you're working on these task-based simulation questions, okay? So what I thought I would do today is access the AICPA auditing practice exam directly at the AICPA website. And hopefully you're aware of that not only do we have our YAEGER materials, but the AICPA does put up practice exams on the AICPA website. So here's the AICPA website, aicpa.org, okay? Our best friends, right, Phil? The AICPA.
We do. I love them, and I actually go to their annual meetings.
Yep, Phil
We have a
attends
big
those.
parade down Fifth Avenue in Manhattan.
In Manhattan, in New York, that's right.
Yes, yes.
Yeah, so at the aicpa.org website, for those of you who are not familiar with it, if you go to the homepage, you go to topics, and you go to CPA exam candidates, up pops this screen, and it says sample tests and tutorial topics. Thank you for visiting the ICPA website. Sample tests and tutorial topics. So I press that. For those of you that want to follow with me, or you can just watch my screen because I'm going to bring everything up. You go to the auditing sample test, and there's my launch code. They give you a launch code, so I just copy and paste that. And I tell it to launch. Hopefully it'll launch, yep. And I paste in the launch code. And I accept and begin the practice exam, which is available at the AICPA website, okay? Okay, so the first two, they generally put 5 simulations up here. The first 2 are multiple choice. I'm not going to cover that today because we want to cover with you the simulation. So I'm going to, hold on one second here. I'm going to skip this. So these are multiple choice questions, the first group. Next comes the second group. They're also multiple choice. So I'm going to submit that because I want to review with you the simulation questions.
Ron, the question, one on the nav bar, one of them says Excel, okay?
Yep.
All right. Now, is that the new advanced Excel or is that the
regular Microsoft Excel, okay? So
basic computations?
Basic computations. So you can use this, and actually I can't use it when I'm doing the simulation practice here, I think, but you can actually use this, Phil, to do computations if you need to do computations, you know, for these simulation questions, yeah. And it's just the basic functions, okay? Or right now it's only basic, right, on auditing. Of course, next year, there's going to be more there with related to data analysis, but not at the moment, okay? All right. So here is a very nice auditing simulation question, okay? And let's review the question. And again, remember, we have about 15 minutes to do each one. So it says Green CPA is completing audit procedures for December 31, year 4 audit of a company, a non-issuer. An auditor from Green attended the physical inventory observation at year end, and they maintain a perpetual inventory system, which is integrated with the general ledger. The auditor noted some issues that require further investigation when reviewing the inventory count sheets and inventory location maps, warehouse location maps. You can see warehouse location map up here, right? Inventory count sheets up here. And they talk about our perpetual inventory listing. Here it is up here, okay? The auditor established the following information related to the inventory count and product lines. There's no product movement on the day of the count, so that's good. The loading dock is part of warehouse A for the purposes of the count. All product lines within the storage area have been identified on the warehouse map. So there's a warehouse map here. You can see there's a warehouse A and a warehouse B, okay? Inventory values in the perpetual inventory listing are based on the most recent purchase price. Materiality for year end is 8,000 for the audit. Performance materiality is 5,000. Complete the inventory task below by using the information provided in the exhibits above. In column B, quantify the required adjustments. So let's look at what we have down here. It looks like we have 3 product lines, widgets, and hex bolts. And it says in column B, quantify the required adjustment, if any, to the product line in the perpetual inventory system. Enter increases as positive, decreases as negative. If no adjustment, put 0. Okay, so we're either going to have positives, negatives, or zeros once we do our evaluation here of the inventory information. In column C, select the justification for the required audit adjustment or the reason why no adjustment is required by selecting from the option list, okay? So here, if you click over here, you can see a bunch of options, I believe. Yeah, all kinds of options for why you're going to make any particular adjustment. Assume there is only one reason for each product line discrepancy. Okay. All right, so typical simulation, Phil, okay? Now, let's take a look at what we have up here with regards to the exhibits they've given us. Well, we have a perpetual inventory listing, right? And pretty typically, right, here are the products. Here are the SKUs, okay, for each one of those products. Hopefully you know what an SKU is, right? Stop keeping unit. The last purchase date for the item. The last purchase cost, unit cost. How many items are in inventory in the perpetual records, and then the valuation of it. By the way, you can assume these numbers are going to be correct, including over here, unless they tell you otherwise. All right, but notice, candidates, there's only 3 items they're asking us about, okay? So Phil, this is a typical AICPA simulation where there's a lot of stuff in here, but really there's only, Phil, 3 items that are important to us, okay? The widget's 10 millimeters, the widget 5 millimeters, and the hex bolts, okay? The rest of them we really don't need to address, all right? So we now know, here's the perpetual inventory listing, the SKU numbers, and that would be good perhaps for you to jot down as you're working on this problem, okay? Is that the widget's 10 millimeters, here's the SKU number, okay? And here's the unit cost, and here's how much is in the perpetual records, 1,000 units, okay? Now, it's telling us there could be adjustments, right, between the perpetual inventory listing and the inventory count sheet. So let's look at, for the widgets, right, what was the count? The 10 millimeter widgets. Well, probably you need to leave this open, right? Because the widget 10 millimeter is 267-1, right? Is the SKU number. So for 267-1, and by the way, you can be scrolling like this as you're doing the simulation. For 267-1, Phil, there's 131 of them here and 119 of them here. Okay, Phil? So using your Excel, if you can do it in your head, the actual inventory count that the auditor came up with for the 10 millimeter widgets was 131 units plus 119 units. And that comes up to a total of 250 units, okay? Well, right, we saw that in the perpetual inventory listing, there's 1,000 units. Why are they different? Okay, that's going to require us, Phil, to look around at the other exhibits to see what other information in there can help us determine why is there a difference between the perpetual inventory number, 1,000 units, and the 250 that we counted. So let's go to the email from the controller and quickly read that, right? And on January 10th, year 5, the auditor emailed the controller and says, can you tell me whether the items in the returns area has been included in the count? And the controller says, yes, they have been included in the counts. However, they would not have yet been processed in the perpetual inventory system. But remember, we have 1,000 units, right, in the perpetual inventory system and only 250 units in the counts, okay? So that's not going to explain to us, I believe, the difference between the perpetual inventory count and the actual auditor count of 250 units. So that doesn't help us. Let's go to the memo from the staff accountant. And there, the staff accountant, there's a memo from the staff auditor to the file saying, I met with the controller to resolve discrepancies between inventory unit item number 267-4. Well, that's the 5 millimeter units, right? Between the counts and the perpetual inventory listing. So just quickly reading that memo, which you should read, you know, that's not going to help us quantify the differences, right? The 750 quantity difference. So we can close that out, but keep in our mind that 267-4, we have a memo there that's going to help us with that particular difference if there is any. So let's go to the supplier report. Okay, 267-1, right? That's what we're looking for. Is there any information for us there? It says in March year 4, JBU bought 5,000 units of 267-1. Half of them have been used. A further 30% were sold to third parties, and 5% of the units are in ending inventory. So if you do some quick math there, Phil, right? 5,000 units times 5% is 250 units. And those is what we saw in the inventory count sheet, right? For those particular ending inventory units. The remaining 15% of the units were provided to a customer on a consignment basis. As of December 31, year 4, all of the consigned units were sold to the customer. Aha. So remember now, right? We had 1,000 units in the perpetual listing, and we only counted 250 units in the count sheet. Therefore, the perpetual records, Phil, are overstated, right? By 750 units, 1,000 minus 250 units. Hopefully everybody follows that. Please let me know. So the perpetual inventory records, right, are overstated, right, by 750 units. Any questions there, Phil?
I'm not seeing anything coming in the chat box, so I think people are following along.
Great. So we take 750 units, right, that the perpetual records are overstated by, times $4.99 per unit. And you would be doing that in Excel on the exam. And here, where it says input your answer, right, you get minus 3,742.50 cents, right? And you hit accept. And there's the amount by which the perpetual inventory records are overstated, right? $3,743. And the justification for the adjustment is, right, items, I believe it was items consigned to customer were sold. Okay, so you have to pick the correct answer there, okay, because there's a lot of potential answers there, but you should remember the reason for that adjustment was the items consigned to the customer were sold, and that was in your supplier report, okay? All right, next one, the 5 millimeter units, okay? 4,102, right, are in the perpetual records, right? I have that up on the screen. Go to the inventory count sheet, which is what the auditor counted when they did the physical inventory count. And again, that item number is 267-4. 267-4, we have 4098 up there and none down here. So actually, the physical inventory count, right, was 4098. I'll close that. And in inventory is 4102, okay? So why is there a difference there is the question, okay? So again, let's look at the information we had. Remember the memo from the staff auditor, right, from the client? I met with the controller on December 31 to resolve the differences between the perpetual inventory listing for 267-4 and the counts. I then visited the warehouse again and I counted 4102 units, right? Which is what the physical inventory, the perpetual inventory actually shows, okay? And I recounted, so in other words, the auditor's count was incorrect, okay? I validated that the perpetual inventory listing for 267-4 was correct, and the initial count on the inventory count sheet was incorrect. Therefore, candidates, do we have an adjustment for the widgets 5 millimeter? Is there an adjustment required? The answer is?
You have a lot of no's.
And they are correct. No adjustment required, right? So I type a 0 in there, okay? And looking at all of the options, right? Errors in the count, right, is the answer, okay? So the count was incorrect by the auditors. That's possible, right? Okay. Last item, hex bolts. 9,875 in the perpetual records. In the inventory count sheet, 561-3. We have 7975 up here in warehouse A and 1,950 in warehouse B. Okay, add those up and we get 9,925. Oops, that's more than the perpetual records show, which is 9,875. What could be the reason for that? Well, we didn't see anything right in the email from the controller, except he or she said, however, they would not have yet been processed, the returns, right, in the perpetual inventory system. So let's go to the warehouse map. We haven't really looked at that yet, right? Here's warehouse A, right? Warehouse B, aha. Returns area, there are hex bolts, okay? It doesn't tell you how many, but you can assume, right, that the hex bolts, as the controller said, are in the returns area, and they were not included in the inventory count made by the auditor, okay? Which means that the perpetual inventory records for the hex bolt, right, are understated by the difference between 9,925 and 9,875, okay? So we take 9,925, right, which was the physical count, subtract the perpetual record quantity, 9,875, we get 50 units times 12.89, and we get an adjustment required for the hex bolts, and it's positive, right, because the perpetual records are understated by 644.50, I believe. Okay, accept. And the reason is, looking at all the options, returns not processed in the inventory perpetual system, except. Okay, questions, candidates? Now, notice here, I just noticed, it's giving us a total here, right? By itself, we don't have to add it here. And let's look at the next question. It says, based on the work performed, select from the option list provided a conclusion as to the ending inventory balance. Assume that the auditor performed any follow-up procedures to confirm the initial reasons for the differences, and therefore any adjustments that we just made are accurate, and there are no other adjustments to consider. Well, if we add up all these adjustments, we get a negative reduction, right, to inventory of $3,000. But remember, right, the performance materiality is $5,000. So this $3,000, right, is less than the performance materiality that was required for inventory of 3098, right? So let's look at our answer choices to answer this question. Based on the inventory work performed, the inventory balance is materially misstated? No. Materially misstated? No. Not materially misstated because the required adjustments are less than audit materiality? No. That's the whole audit. That's not relevant to the for the inventory. So the answer must be, based on the inventory work performed, the inventory balance is not materially misstated because the required adjustments are less than the performance materiality. Okay?
Ron, can you answer this question?
Yes.
The gentleman says, can you repeat the widget 5mm, please?
So the difference between the perpetual inventory and the actual inventory count was that the auditor admitted in this document, in this memo, included in the work papers, that when the auditors counted the 5mm widgets, that they didn't count them correctly. So the auditor went back out to the warehouse, right, on December 31 and recounted the 5mm widgets and found that their counts were incorrect and that the perpetual inventory numbers that the client has are correct. That's the explanation. So therefore,
Ron, can you explain on this problem with this inventory? What are you adjusting to what?
So it tells you, right, Phil, in the question, it tells you that the perpetual inventory system is integrated with the general ledger, Phil, right?
Okay.
So that means that the balance in this perpetual inventory listing of 182,655.39, which includes those three inventory items, agrees to the general ledger balance for inventory. So in your audit here, you're finding discrepancies between this balance, right, and the results of the inventory counting done by the auditor to adjust inventory, right, on the general ledger.
I think I can say, I'd say, here's a question here, first of all. Apologies, but could you please go over how you got the $645 for hex bolts?
So on the hex bolts, what I explained was there was hex bolts in the return area, right, in warehouse B, right, which the controller said here in the note to the auditor that returns are included in the counts, but have not been processed in the perpetual inventory system. That means, Phil, that the quantity of the hex bolts in the perpetual inventory system are understated by the returns that have not been processed yet into the perpetual inventory system. It's tough to understand, but that's the explanation.
So really, you took a count. You're saying the counts include these, correct?
The count by
However,
the auditor up here in
general
the count sheet,
ledger-
yep, the general ledger was
has to
wrong.
be corrected to
Yep.
agree to the count, correct?
Exactly. Yep. Very good, Phil. Perfect. Welcome to auditing. Okay.
This would probably, the reason this has been released is it's probably a pre-test problem.
Yep.
I would guess that.
Yep.
Because they don't release any problems they're going to keep using.
Yeah, yeah. But
And
it's a
what
good
would you consider
example too.
on easy, hard, medium? What would you think?
This is a toughie, Phil. This is a toughie because you got to understand the link between perpetual inventory and the general ledger. You have to understand the impact of the auditor's accounts to the perpetual inventory system. And also you have to take the consideration, right? These four documents, right? The warehouse, the memo, the supplier report, and the email, but there's also a lot of superfluous information, right? On some of these documents. So this is a tough 15-minute
Now, where do
sim.
you learn this? So is this what you would learn in auditing?
Yes. Oh yeah,
So
definitely.
when you're teaching auditing, all right, is the person supposedly supposed to teach the material they would need to answer this?
Yes. Yep. Correct.
Based on what? And when you do auditing, all right, what do they teach you in auditing concerning this problem?
Cause and effect, right, of differences between the general ledger, right, and physical observations. I mean, and what's the impact and what's the entries you have to make, right? And looking at working papers and correspondence, you know, to piece it all together. It's an audit trail, Phil, and audit evidence. Yep. It's a whole bunch of concepts together at one time, to be honest. Okay, let's keep going because that one I spent a lot of time on because it was pretty complicated. Hopefully the next one is not the same. Oh, it is. Okay. A CPA firm is preparing for the year 6 audit of YAEGER. An audit staff member used the year 5 audit request list for YAEGER as the basis for drafting the year 6 request list. In other words, you're requesting documents from the client in order to perform your audit. Additional client information was obtained during the audit planning for the client. As the audit senior, it's your responsibility to review and revise the year 6 request. So here's the audit request list, a draft of it, for YAEGER as needed. Use the additional client information in the exhibits above to revise the draft request list, correcting any errors and removing any inappropriate or unnecessary items given the overall context and purpose of the list. In other words, they're testing you on whether you understand what type of audit evidence do you need to accumulate for these different requests down below. Ensure that the year 6 list is appropriate given the information provided. Very important, the materiality for the year 6 audit is $55,000. So in other words, anything less than $55,000 is not material. Above it, of course, is. To revise the audit request list, click on each segment of the underline. So they only want us to deal with these underlined text below and select the needed correction, if any. If the underlined text is already correct, select original text from the list. If the removal of the underlined text is the best revision, delete it. Okay. So up here, they've given us a comparative trial balance, okay, for this client. So you should understand what a comparative trial balance is, okay? See if I can expand this a little bit. Yeah. So we have year 6, right? The year under audit, and year 5. Here's all the general ledger account numbers, unadjusted trial balance, and all the accounts, right? Balance sheet, probably income statement. Yeah, here's all the income statement accounts. And the balances in those accounts, debits and credits, okay? So we're gonna need to know that or go back to it. An email from the CFO, and the CFO tells the controller in this memo, we have agreed for the terms of purchase for our office in the Edgewater estate with a closing date of August 31, year 6. Well, that's the year under audit, right? Year 6. The agreed purchase price for the property is $2,287,525. Okay, so just keep that in mind. And then finally, the other document we're given is a special meeting. Looks like of the maybe of the board of directors during year 6, right? The year under audit. And there's been some loans to shareholders, it looks like, right? So let's keep that in mind as we go through the list here. Okay. So the first item underlined that they're asking us to look into is the Edgewater Industrial Estate Lease Agreement. Okay. Well, didn't we just see that there was a lease agreement, but now we've purchased it, right? So let's go back to the trial balance, right? And do we see something in the trial balance related to the purchase of the Edgewater building? Aha, look. Account number 1750, buildings 2287525. 2287, Phil, 525. There is the acquisition of the Edgewater Estate building for the year. Okay, so Phil, what type of audit documentation? It says here lease agreement, right? I think more important than the lease agreement is we probably need what, Phil?
Well, you have to know what type of lease it is, don't you?
Yep, but also since we now purchased it, right, Phil?
Yeah.
And we put on the balance sheet a $2.3 million new asset, right?
You'd have to look at the document on the closing of the building.
Correct. So that is the
Closing
purchase
paper.
contract, right, Phil?
I'm sorry?
The purchase contract, right?
Right.
I mean, the lease agreement, we leased it in the past, right? We probably already have a copy of that lease agreement, okay?
Mhm.
The property insurance, you know, that's probably not as important as we need to see that purchase agreement, okay, on that acquisition, because that's way above, right, our $55,000. So I don't think, you know, it said in their lease agreement, right, originally.
Mhm.
I think what's more important, we need a copy from the client of the purchase contract, okay? And that's what this question is testing, Phil. Do you understand what type of audit documentation you need, especially for an item this big, right, that has been added to, see, last year, Phil, there was nothing here on the buildings. Now it's 2.3 million, okay?
Mhm.
All right, so that's that one. Next one, furniture and fixtures purchase documentation. Furniture and fixtures. Well, let's go to the general ledger, right? Do we have furniture and fixtures somewhere? Here it
Yes,
is,
1650.
right there, furniture and fixtures. Phil, did it change at all?
No, so they didn't purchase anymore. They
Didn't buy anymore, right? So why do we need, right, furniture and picture purchase documentation when there's no change, right, in the furniture and fixture account, right? So we don't need a sale, we don't need a purchase, we don't need a sale. And remember the instruction said if you don't need it, right, just cross through the text. So for that one, fortunately, I think I picked the right one. We don't need that documentation. Okay, next one, new motor vehicle purchase agreement. So let's go to the trial balance, right? Motor vehicle.
Vehicles.
Where's vehicles?
1,700.
1,700. Okay, last year we had 36.5. This year we have 0. So we definitely don't need purchase agreement, do we, Phil?
No.
Because there's nothing
Nice
on
to
the
have a
books.
sales agreement.
Probably have a sales agreement. Maybe we should check the income statement, right? General ledger accounts.
Any gains, losses? Let's see.
Gains or losses? Gains or loss? Oh, there it is, Phil. Gain, 8,925 was booked this year, Phil. For the current year, we need that, not for last year, right? That audit's done already. So let's look at our options here. New motor vehicle purchase agreement? No. Document supporting the sale of motor vehicle asset? Absolutely, right, Phil?
Right.
We need that one. Okay, that takes care of that one. Next, documentation supporting issuance of 50,000 shares at 30 cents per share. Okay. So Phil, what accounts would we go to on the trial balance for that?
Stock and APIC.
Exactly. So let's go to common stock. 50,000 shares, right? Well, it went up from 10,000 to 15,000, right, Phil?
Right.
So it's 5,000. 50,000 shares at 10 cents. That explains the change, right, Phil? And then additional paid-in capital went from 100 to 110. So 50,000 shares at 20 cents per share, right? Additional paid-in capital
10,000.
is
Yeah.
10,000. So that explains that, right? So we would need, right, the documentation for, right, the 50,000 shares So let's look at our choices here. 50,000 shares at 30 cents. Yep. No, we don't need just the 10 cents, Phil, right? We need the whole 30 cents, right? So I think the original text there is probably correct. And see how sneaky they are, Phil? They have one for 10 cents, one for 20 cents, right? They're all there. And by the way, 150,000 shares in case you do the wrong math, and 50,000 shares, right? So the original request is correct. Yep, it is.
I have a question here. Well, it just, I don't know if this is a comment. Someone wrote to you, said deed ownership document. I don't know. What
Yeah, if that was an
I
option under the industrial estate, yeah, you would have picked that.
I don't think that was
That was not an option. No,
No.
it wasn't an option.
Also, another person wrote receipts.
Yeah,
Yeah.
both of those comments came in a little while ago, so I think they were referring to other items.
Yeah, but here, you see, Phil, those were not options, okay? So the most logical option there is you want to start with the purchase contract, okay?
You don't want to pick options that aren't there.
Yeah, if they're not there, you can't put them in, all right? They're
Right.
giving you the options. Good questions, candidates. All right, next, management's review of third-party interest rates, okay? Oh, remember, right? There was this loan to shareholder stuff. Remember this? So this says, special meeting of the board was called for the purpose of loan to shareholders. They routinely provide loans to shareholders when requested in prior periods. The current loan balance outstanding related to a loan to Mr. Moore. At the end of the year, it's $25,000. The loan will be repaid next year. It doesn't say anything about interest rates. But Jay Hiver has made a request for $225 loan. The monthly loan payments start in year 8, 20 months. Repayments are equal installments of 12.5. The loan will be interest-free. Ooh, okay. Probably some type of related party transaction, right? And the board approved it. That loan to Jay Hiver be approved as circulated, approved by forum, okay? So what we would need here is management's review, right, of third-party loan interest rates, but actually we also want, right, a copy of the loan agreement, right? We need to look at that loan agreement and then confirm, right, that that loan agreement was executed and what the interest rate was, okay? Not Mr. Moore, because that was the year before. Evidence of approval by D. Chen. I don't see not present D. Chen. Why would you want the approval of D. Chen, right, when they're not there? Management's due diligence related. So the best answer is here, let's get a copy of the loan agreement, right, with Jay Hiver, because that is primary audit evidence, Phil. That's why that is the best answer there, okay? Last. Now remember, right, the materiality here is 50,000, right? 55,000. And the auditor said, well, let's look at account 6,900. Well, let's look at account 6,900, Phil. Did that change by 55,000, Phil, from year to year?
Yes, yes.
Wait, 6,900.
It's
No.
sundry expense.
No, it only changed by $50. The materiality is
From
55.
$890 to $940. Is that 50? Yes.
Only $50, not 55,000.
It's not material enough.
Not material enough, so that's a bad request, right? Let's look at the other expenses, Phil. Income tax expense, that's a separate calculation. Did bank interest expense change by 55,000? No. Bad debt expense, we will do that with receivables, right? Depreciation didn't change by 55,000. Phil, repairs and maintenance. Big change, right? Huge.
Yeah.
Utilities, 55,000 change? No. Postage? No. Travel? No. Business meals? No. Auditing and accounting fees? No. Legal fees? No. Sundry expense? No. Okay. So the idea is we want to be looking at miscellaneous expenses. Okay. So the one with the biggest change, right, is, Phil, repairs and repairs and maintenance, right?
Yeah,
Yep.
it was from 14.5 to 137.
Yep, that's the biggest one. Okay, these other accounts you should know from your auditing skills, right? Raw materials, you'll look at that on the purchasing cycle. Payroll, you'll look in the payroll cycle. Freight expense, you'll look at that in the materials cycle. Insurance expense didn't change by more than 55,000. Payroll did, right? But that's its own transaction cycle, Phil. So you'll look at all the payroll stuff in the payroll analysis and payroll cycle, okay? So we're really looking at all the miscellaneous expenses except those that are connected to other auditing techniques or procedures. All right, so the answer here is account 7,500, and I'll hit accept, and that answer is also correct. Questions on those candidates? Phil, this is a good one too, I think. Pretty tough.
Yeah, these are very difficult.
Yes, yeah, but it gives you an idea though, right, of the challenges that you will have.
Except there's one thing here. I think this is a pre-test problem.
Yeah, could be.
Now,
Okay,
what do you do when you come to if you think you have a sim like this, all right,
Yep.
you should try to do it. Is that correct?
Oh, yes, definitely. You
Okay.
should work on these, yeah. Okay, Phil, let's do another one. All right, an engagement team is performing the audit of financial statements of Griffith as of for the year December 31, year 7. The senior accountant has identified 3 misstatements that have been carried forward into the summary of proposed audit adjustments. Determine the impact of these identified misstatements on the financial statement ratios below. Oh, financial statement ratios. Okay, important to know those candidates for the BEC part of the for the auditing part of the exam. Okay, and by the way, okay, let's keep going. For each of the identified misstatements below, indicate the impact on the financial ratio identified in columns D and E. So D, what's the impact on the current ratio? E, what's the impact on the profit margin ratio? So you should know what those ratios are. Select the impact, if any, that the misstatement has on those ratios. Selections made only once, more than once, or not at all. Consider each misstatement independently. The information in the analytics definition exhibit must be used for all the financial ratio calculations. So we have an exhibit up here, analytics definitions, and they've been very kind to you to tell you that the current ratio is calculated by taking current assets over current liabilities. And since that one is there, the profit margin ratio must be here, right there, right? Net income over sales, okay? So I would open that up since they've been very kind to give you those ratios, how they're calculated. And now you're looking at the entries, right? The adjustments that need to be made. And you need to determine the impact on those ratios of making these adjustments. So the first one is debit payroll expense, right? Which means expenses go, candidates, up or down?
These were not recorded, is that correct?
Not recorded yet. So by
So our
debiting
expenses,
payroll expenses,
All right, current ratio is current assets, current liabilities, right?
yep. So payroll expense goes up. Does that affect the current ratio?
No effect.
No effect. What about the profit margin ratio?
Well, if you fail to record an expense, all right,
Profits go,
they're up, they're overstated.
profits
Right.
go down, right?
No,
So
but are you
but-
saying when you record it?
when you record it,
Okay.
profit margins
Yes.
go down, therefore the
Yes.
profit margin ratio goes down.
Yeah.
Right? Credit to accrued payroll, right? That's a liability. What does that do to the current ratio? Current liabilities in the denominator go up.
I recommend what you do is you take, if you can't see it, all right,
Yep.
take the ratio, current
Yep.
assets,
Yep.
current liabilities, okay? All
Yep.
right, and you have, let's assume the current assets are $100,
Yep.
and
Make it 100,000. Make it 100,000, Phil.
what? No, I'm just
100. Okay, so make it 100.
working with numbers. Current
Yep.
liabilities are 50. They should be higher, right? Let's
Yep.
make it 70. So you go, let me see here. Yep, it was my calculator. You see, what I'm doing is I always take very small numbers. and see how it affects it. I wouldn't put 72,000,
So what did you put for current assets? How much?
100.
Okay, and current liabilities?
Well, they were 50, all right,
50.
without the journal entry.
So right now the ratio is 2 to 1, right?
Correct.
So now let's do 100 divided by
70, right?
70. Yep. What's the ratio?
1.4
Right. So the current ratio went
down,
right. So the answer here is the current ratio decreased,
right?
right? And then for the profit margin ratio, we know that's net income, right? Divided by sales.
Right.
Okay. Let's say net income is 10 and sales are 100,
Mhm.
right? So the ratio there is 0.10,
Right.
right? And if we reduce net income from 10 to 7
Mhm.
and sales stay the same at 100, the new ratio is 0.07, right?
Right.
And the profit margin ratio therefore
Goes down.
will decrease, right?
Right.
So Phil's suggestion there is excellent, okay? Put some numbers down if you don't want to guess, okay? Next one, depreciation expense goes up.
No
and
effect on, no effect on the current ratio.
No effect on the current ratio, no effect on current assets, no effect
Right.
on current liabilities, right? So
Right.
no impact. However, expenses go up, right? Just like the previous one, right? Expenses go up, therefore the profit margin
will go down.
ratio decreases, right?
Right.
Good. Everybody got that, candidates? Last one, debit prepaid insurance. We know prepaid insurance is an current
Current
asset,
asset.
right?
Current asset.
Current assets go up, the current ratio goes up,
Right.
right? Insurance expense goes down, the net profit margin or net income goes up, therefore the net profit margin ratio increases,
Right.
okay? Very typical simulation question, Phil, okay? All right. We still have time? Yes.
We still have
okay.
about 10 minutes. Yep.
Great. All right. Second part of the simulation. So here you have a two-part simulation, okay? The engagement manager has requested a summary of proposed audit adjustments started by the senior accountant be updated for any additional misstatements identified. Use the information in the exhibits below, or the exhibits above, sorry, to determine the adjusting entries required. Each adjusting journal entry can be entered in any of the 3 response tables provided. To prepare each required journal entry, click on the cell in the account name. So we click here and we see all these names, okay, for accounts that can be debited or credited, okay? And select the appropriate account. An account may be used once or not at all. Enter the corresponding debit or credit amount here, right? So there's going to be a dollar amount probably entered here. All amounts will automatically be rounded to the nearest dollar. Not all rows in the table may be needed. So there's 3 rows in each table. Okay. So we need to look up here, right? And we're probably going to find, well, we already did this analytics definitions for the ratios. So probably not going to need that exhibit anymore. See if I can close it. It doesn't want to close. Okay. Debt restructuring email. Dear Senior Auditor, Griffith has refinanced its credit facility. I reviewed the executed contract on December 28th, year 7, right? That's during the audit. The maturity of the loan was extended from September 30, year 8 to December 31, year 14. So candidates, that should generally tell you a hint that this loan has been extended from a current loan to some type of long-term loan. The entire $3.4 million balance of the loan was classified as current at December 31, year 7. So we now know that's not correct. The loan principal is payable with quarterly installments of $225,000. The first quarterly payment is due March 31, year 8. So candidates, get out a piece of paper, and right now you know that on the balance sheet there is a $3.4 million current liability in the form of a loan, right? Which has now been executed into a longer term agreement. How much, candidates, of that $3.4 million short-term loan should be classified as a short-term loan on the balance sheet? I'll give you a second. How much on the balance sheet of that 3.4 million balance loan should be classified as a short-term loan, and therefore how much as a long-term loan? Any answers? What you should be doing, right, is multiplying 225,000.
2.5 million,
How much?
2.5.
2.5, right, should be reclassified, right, from short-term to long-term, because the short-term portion now should be only what? 225 times 4, right? The quarterly installments of principal are 225 times 4, which is 900,000, right? So 3.4 million minus 900,000 is 2.5 million, right? So we should debit current portion of long-term debt, 2.5 million. And credit long-term debt, 2.5 million.
We show one person that said 900,000 short-term, 2,000,005 long-term.
That's correct. And by making this adjusting entry, that's what it accomplishes, okay?
Okay.
But don't be fooled. The entry is not 3.4 million. The entry is not 900,000. Because remember, the balance sheet has on it 3.4 million is classified as current, right? It tells you that right there. So you got to take that in consideration, right? Because the engagement manager has requested a summary of proposed audit adjustments, and that's what you're doing right here with that entry, okay? All right, next. Must be more here somewhere. Audit working papers. And let me promise you something. On the auditing exam, you will get some sample auditing work papers. Phil mentioned that on one of our previous questions, okay? So here's an audit work paper on this client done by the staff accountant, reviewed by the senior, and apparently they were auditing service revenue, okay? So service revenue comes out to this number. And here's all the different transactions. And the purpose was, is the right amount of service revenue been recognized during the year, okay? So here's a bunch of clients, here's a bunch of amounts, and here's the famous tick marks we do in auditing, right? Audit tick mark A, B, and C. So let's see what tick mark A says. Per review of the contract, invoice and service records, all of those with an A by it, we recalculated the amount of revenue earned and verified that the revenue was recognized in the correct period. What does that mean, candidates? Are there any adjustments required for any of the tick marks with A on them? Have we audited all of those with the tick marks of A on them? Are they correctly stated, candidates?
Says so.
Yeah, I think so, right?
They were verified that the revenue was recognized in the correct period.
Yeah, so really there's no adjustments required, right? For all of the customer amounts there, right? Which have a tick mark of A, okay? So you got to be digging, right? When you're doing these auditing questions and reviewing very quickly, but very thoroughly, right? All the information you're given. So let's go to B. B, per review of the contract and service records, service was finalized and invoiced as of December 31, year 7. Per review of the ledger detail, the receivable balance was recorded in unbilled receivables as of year end. Unbilled receivables. Any adjustment required?
Yes.
Yeah. What's this unbilled
I would say
receivable?
debit.
Debit?
It has to-
Debit what, Phil? Debit? Accounts
Unbilled.
receivable?
Yeah, accounts receivable.
Hold on.
Wait, it
By
says
how
here,
much, Phil?
per review, let me just read it. Per review contract service was finalized, okay. Per review of ledger detail, the receivable balance was recorded in unbilled receivables. So you want to credit unbilled receivables
Yep.
and debit
There.
accounts receivable for letter B. Look at the tick marks, 75,000.
You got it, Phil. Very good. Okay. Last, Phil. Okay, so we took care of B. What about C? Per review of the $50,000 contract, right, with Globe Inc., service was for the period December 15, year 7 through January 14, year 8, and should be recognized equally between year 7 and year 8 based on the terms of the contract. So Phil, should we have recorded all of that $50,000 of revenue in year 7 for Globe?
Wouldn't it be half?
Half, exactly. So we need an adjusting entry, right?
Yeah.
Debit
Debit
revenue, right?
Debit
Debit
revenue.
service revenue.
and credit unearned.
So debit revenue, right?
Credit unearned revenue.
Yep. Oops.
We got a
And
person.
credit, let's see what kind of an account we got here. Contract liability is, I think, as close as we're gonna get.
That's the only unearned revenue.
Looks like it, yeah, deferred
Is
rent,
there an
no.
unbilled, what'd they say?
Unbilled receivable, no. Contract liability, that should really be unearned revenue, would
Yeah.
be better, you know? Maybe why the CPA, they released this question. Okay, done. Those are the 3 adjustments, okay? Questions, candidates? I have 3 minutes, yeah. So
Now,
Phil, we went
how do you
through 3.
prepare? You know what? There's really no way to prepare
No,
because
no,
it's sort of a unique question.
very unique, Phil. Very unique. Hey, Phil, I could go through this quickly, Phil, the last sim.
Go ahead. You got about 4 minutes. You can do it, Ron.
Yes, okay. So Bestwood Furniture, a non-issuer, is undergoing an audit. The situations below describe changes made during year 2 that may or may not contribute to audit risk, okay? So audit risk is a very important concept, okay, in auditing. So they may or may not. For each situation, select the impact of any that the situation has on a specific component of audit risk for year 2. Selections may be used more than once, or used once, more than once, or not at all. Consider each situation independently. Okay, in year 2, the auditor notes that the company's newly hired purchasing agent was not obtaining competitive bids for all major purchase acquisitions, okay?
That would increase. Well, what's it? You have to know the different types of risk, right?
Yeah. So what kind of a risk is this, candidates? Control risk, detection risk, inherent risk, or no impact? Of course, there's an impact, right? Of not obtaining competitive
Very
risk.
quickly, what's control risk, Ron?
Let me see what the candidates say.
Oh, okay.
This is a control
Control
risk,
risk
isn't it,
increasing.
candidate? Isn't this a control risk? Yes, of course, right? Control risk, right, is
What
going
is
to
a
increase.
control risk?
This is a basic internal control, isn't it, Phil? Not
Okay.
not obtaining
Oh, I
competitive.
see. Okay, yes.
Not yeah. Now it's also going to increase the other risk, okay? But it starts with increasing control risk, okay?
Okay,
So that's going to be the answer there. I'm fairly certain.
okay.
Next one. In year 2, the company expands its warranty program to cover additional major products in an effort to increase sales. Not really a control risk, right, Phil?
No,
More of a
inherent.
inherent risk, right?
Yeah.
Not detection, nothing to do with detection, okay? That's audit stuff, okay? It inherently increases the risk that the warranty reserve, right, is understated, okay, potentially understated.
Okay.
Next one, the audit partner decides the audit team needs to perform additional tests of detail over payroll in addition to the substantive analytical procedures done last year on payroll. So this, Phil, is an audit procedure, right?
Okay.
So
Is
by
that
doing
detection
this,
risk?
right, Phil, by doing these additional audit procedures, right, you will decrease Audit detection risk. Yes, exactly. Okay. Next one. In year 2, the company budgets the creation of an internal audit department, which will commence its operations in year 3. What effect does this have on the year 2 audit, Phil?
I was looking at the responses, I'm sorry. The company budgeted for the creation of an internal audit department, which will commence operations in year 3.
But this is the
That's
year
gonna
2 audit.
decrease- That will decrease.
No,
And
no,
what
no.
year
This
is
is
it?
the year 2 audit, Phil. No
Right.
impact on the audit risk for year 2.
Because it's going to commence in year 3, right?
Exactly. So be
And they only
careful,
want to go year
candidates.
2. They only
Yes.
want to go year 2.
Yeah, because this is only affecting year 2 we're looking at. Last one, in January year 2, the corporate controller implements a supervisory review of all internally prepared reconciliations. Control risk, Phil. The auditor determines that the controls, it even tells you that, okay, are designed and operating effectively for the period, okay? Control risk goes down, right? It's an additional control and it's working, right? Therefore, this particular situation decreases control.
And Ron,
risk.
you said what, 15 minutes for all these? This is one sim?
Yo, there's a second sim here, but we're not going to get to it. But for
Oh,
the other ones we went through were all 15 minutes. This is part 1 of a sim.
So this is 15 minutes alone?
No, this is part 1. Then there's another sim part of this one coming up,
Oh.
which we're not going to cover now. Okay. Yep.
It seems to me you have to know this stuff cold.
Yes, you have to know, in this case, difference between control risk, audit risk, inherent risk, and detection risk. This is a pretty good question here, Phil. Normally would be in multiple choice questions too. So we hope today going through these simulations have helped you. I've gone through almost all of them now in auditing, and we hope that this will boost your confidence, or hopefully we'll also tell you what concepts you need to study further as you study for the auditing exam. And so I turn it over to Phil and to Karen.
Well, do they follow the blueprint?
Absolutely, Phil. All of these are in the blueprint, Phil, of
Okay.
course. Every one of them.
All right. So Ron said it best. You got to know the blueprints.
Yes.
You know, if you don't look at a blueprint when you're building a house, what do you just do? Build it?
Yeah, exactly.
You have to have a map of some type, all right,
Yes,
to navigate, to build the house, all right? You can't just take something that is old, like content specification only, all right? That doesn't work. That wouldn't give you the plan, the blueprint.
Mhm.
You know, we say this over and over, Ron, and you know, I find, all right, really, and I'm sure the people get sick of us telling them, but what about, you know, if they don't have courses, they use the blueprints. They could pass, couldn't they, Ron?
They could, but it's just going to be easier and more focused, right, Phil? If you have the blueprints. And you know what we do with our candidates too is isolate with them where they don't feel confident with the blueprints and try to help them, not only with our materials, but with our instructor hotlines and all the other services that we provide.
All right, now here's the last multiple choice of the day, Ron.
Yes.
Right? All right, you have a candidate who keeps getting 67 on the exam. First time, second time, and third time. Or even the first and second time, okay?
Yeah.
All right, they are studying with a course, all right, that doesn't cover the blueprints, the old content specification.
Yeah.
And also, all right, they feel that it's their fault, all right?
Yeah.
The answer is this. One, is it their fault? No,
No.
because you're using the wrong information, all
Yeah.
right?
Yeah.
All right. Did you fail because you were not using the blueprints? That would be a good one, right?
Yeah.
All right.
Possible.
And most importantly, all right, keep in mind, you keep studying, all right, with the same dumpy, crappy course, all right? By the way, that's a course called Dumpy and Crappy. If you keep using that course, all right, what are you doing? You're wasting your time. Now, if you don't think your time is worth anything, then fine, keep taking it with that course. But I don't know about you, Ron. I think my time is worth something.
Yeah.
All right.
Exactly.
And whatever the difference might be, and by the way, if you look at our prices, they're so price competitive. All right.
Yeah.
And this is another thing that really came up. This person said to me, well, you know, their course is running out, right? They could pay another $500 to $700 and get that course reinstalled. And I said to them, why pay that? That course doesn't have the blueprint. It's not going to magically appear if you pay that $500 to $700. So it's time to look into other courses. And looking into other courses means you look at demos of the instructors, all right? We have shown you our materials. Have our competitors shown you their materials? I don't know, all right? They'd only have to show it to you if they did webinars. Well, their webinars, as they call it, is to tell you how the CPA exam is being affected by the COVID virus.
Yeah.
That's not a question on the exam.
No.
We're doing information to show you what our books are like, and also, all right, how using our books will help you pass the exam. And we even do representative sample questions. Ron went to the AICPA website. You can do that, but he showed you a large problem, the different type of simulation, which in most cases, that was a document simulation. Another one was what, risk? What would you call that, Ron?
Yeah,
The one with the risk.
audit risk, yep.
Yeah, that's not a document, is it?
No, I mean, it's just conceptual, really,
The
Phil.
conceptual one, all
Yeah.
right? So, ladies and gentlemen, please, please, we want you to pass, all right? We are not here to want you just to buy our course, all right? Hey, you need to do this. You need to take a good look in the mirror and say this. If I keep studying with this other course, am I going to pass? Well, I didn't pass the first, second, third time. So therefore, remember, all right, as Ron just wrote, passing is our #1 priority for you. And that is so true. It is our #1 priority. Every one of us stand here, speak, pour out our guts so that you will pass this exam.
And Phil, this week we had a lot of candidates, right, contact us that finally have passed after years.
Yeah.
Very satisfying week for us this past week.
So anyway, a lot of the people, Ron, are saying thank you to you, Ron.
Yep.
And
Pleasure, everybody.
and once again, tune in next time, all right? And Carrie, I'll let you say the final words, all right? I want you to tune in next week because next week we're doing what? Regulation?
Yes.
All right. Now, what I'm going to do is something new. All right. I have a new act I'm going to mention. It's the Tax Cuts and Jobs Act of 2030. Or as we call it, the new Biden Act.
Truly,
No,
truly
just-
cutting edge content that we're
Take it
going
away.
to deliver.
Take it away, Carrie.
We don't have a knife to cut it yet.
Take it away, Carrie.
All right. So
So
anyway, just kidding. Just kidding. All right. I generally don't do those types of quick political type things, but no, anyway, it's